back on Smart Markets, and let's talk about all that went down on trading floors today. The Nifty ending above 10,000 for the first time ever, as easy liquidity and strong corporate earnings clearly continuing to lift investor sentiment. Today, you had metals, pharma, as well as private banks that backed the gains. In fact, a broad-based rally in commodities like iron ore and copper actually meant that the metal index reached its highest level in almost 3 years. As far as heavyweights go, Reliance Industries, Yes Bank and ICICI Bank contributed the most to the gains that you saw on the Nifty. All major sectoral indices today have closed in the green, barring the Nifty PSU Bank. Well, with that, let's welcome on board our guests who are joining in on the show. With me in the studio, Mr. Ajay Bagga, who stays on. We've got Exide Life Insurance CIO, Shyam Sundar Bhatt. And also joining in through a Skype connection is Ashish Kyal, founder and CEO of Waves Strategy Advisors. And as we promised, we've got our phone lines open and we're going to be taking queries from you, the viewers. But before we do that, let's quickly get a sense of what each of our market experts has to say as far as the current momentum in the market goes. Ajay, let me start with you. And you know, oftentimes the complaint that we hear these days from money managers is that markets have run up so much so soon. It's getting tougher and tougher to find investable ideas in this market. What do viewers and participants who feel that they want to join the rally, what is a strategy that they should adopt at this point?
Well, I think the strategy has to be diversify as much as you can and split up your money. So invest it in a slow manner, especially in systematic investment plans through mutual funds or index ETFs. That is the best way to do it. So no concentrated exposure and don't put all the money together, especially when markets are at such elevated levels. But having said that, 2 or 3 things I would like to tell. A, nobody knows where is the top of the market. A year later, we would realize that's the top or the bottom of the market. So that prediction is very difficult. Second, in the short term, markets are run by sentiments, but every time they come back to fundamentals. And fundamentals of India are good. They will improve over the next 3 years. If that is your view, then you should be investing in these markets. And third big part is equities remains an investment class of choice. It is very liquid. It gives you very good returns on a longer period of time, but you can lose your money as well. So better to go through index ETFs in the beginning, learn the game, and then step into direct stocks. Mutual funds also offer a good alternative. And split your money. That is very critical at junctures like this. We don't know. This might be a 14,000 market for all we know in the next 2 years. So how can we say that the markets are looking very toppish and stay away when the economy is growing and the corporate turnaround is about to happen?
Okay. Okay, let's actually invite our first caller then for the evening. Rajesh Kumar from Punjab has called in. Good evening, Rajesh. Tell us what your query is.
Hello.
Yes, Rajesh, go on.
Yes, ma'am, I'm a new investor. Can I invest at the present level of market? What is the future of?
Okay, I think Rajesh, Ajay pretty much, summed up what he felt about entering the market at these levels. But Ajay, I want to sort of, throw it back to you and say for people like Rajesh who are new investors and, every day grabbing headlines is, the stratospheric levels of the market. How should one go about looking at investing? Maybe mutual funds is a good idea. Would you say that's a good way to start?
Yeah, and very critical, Tanya, that you see what is your time horizon, what is your risk appetite. So based on that, what will happen is at these elevated levels, you will have to hold the stocks for a longer period of time to get returns. So my short answer is, Rajesh, you must invest. Start with a mutual fund or an index ETF. There are very good ETFs which are exchange traded funds which give you exposure to the entire stock market for as little as 5,000 rupees. You can buy the whole market and start with that. And if you have 100 rupees to invest, invest about 5 to 7 rupees a month, invest over 10-12 months, don't invest it all together. So that way you will learn also and you will average out your investments.
Well, Rajesh, we hope that answered your question. Let's take our next caller. Dhruv Kashyap is calling from Delhi. Dhruv, good evening.
Hi, good evening. A quick question. I hold about 359 shares of Eicher Motors, which I have bought at an average of 19,111 over the last 1.5 years in multiple tranches.
All right.
I have no need for this money. I can keep it for the next 30 years.
Okay.
But the question really was that what is the fundamental sort of price target by Diwali next year, so October, November 2018, as well as October, November 2019.
Okay.
So if I was to ask a 1 year and a 2 year kind of this thing, what should I look for if I was to hold on?
Okay, great.
And holding on is not a problem. I can hold on for the next 30 years.
Okay. Yeah. Ashish, I think that question is absolutely up your alley. I'll just, recap it for you. He has bought Eicher Motors, as you heard him say, at 359 shares for 1911. He says he wants to know 2 price targets for 2018 and for 2019.
Good evening, Tanya. See, the overall momentum for this specific stock has been absolutely positive. And not only over short term, if you look at the long term charts over the years of 3 years or 5 years, this stock you can clearly see has been going from left side down to the upside on the right hand corner. So that is a clear indication that the trend for the stock is on the upside. Now, as far as the targets are concerned on the upside, I think the best strategy to follow, since his entry level has been excellent, the best strategy to follow is to stay long on the stocks which are long term bullish, and thereby creating a portfolio of stocks where the long-term momentum has been intact, the long-term trend has been intact. So diversifying across a few other stocks, not holding on only to one stock. I would say it has to be a portfolio of stocks, maybe around 8 to 10 stocks at minimum, that he should hold on. And for Eicher Motors, I am extremely bullish because the entire auto space has done exceptionally well. Look at Maruti, look at the other auto sectors as well. So the auto and auto ancillary is going to benefit maximum from the India's growth story and should do exceptionally well. So hold on to this stock. Follow a trailing stop method if you want. Probably you can use 25,000 as a trailing stop method, just in case the worst case scenario, if the stock comes down below that, it's better to exit. But hold on, and probably we can even see the targets of maybe 40,000 from here on. Who knows?
All right. Well, Dhruv, hopefully that answered your question. Let's take it across to Rahul then. And he's phoned us from Kanpur. Rahul, go ahead. What's your query?
Hi, actually, I have a question for the Lupin and Sun Pharma.
Okay. So Rahul says that is it a good time to invest in Lupin and Sun Pharma? Ajay, let me first ask you that. And this is a question that many folks have been asking us. Will it be a contra call if I look at IT and pharma both that many would argue are looking a little less expensive compared to say those that have run up quite a bit? What's your sense? I mean, I know you don't talk about stock specific, but overall, big large cap pharma companies worth looking re-looking at?
Yeah, the positives are the valuations are lower now because of various reasons. And what are those reasons? One, the FDA has been increasing the inspections and putting a lot of bans. Their US revenues are forecasted to fall about 7 to 10% year on year for most large pharma companies. Third, this quarter, the impact is on GST, the destocking. So the Indian domestic business, which is a larger margin business, that has also suffered. So these stocks are very under-owned. It might be a good time to get in but you will have to keep a 3 to 5 year perspective. I personally think smaller mid-cap pharma or stories like biosimilars, some other stories might be better than the large cap pharma, which is a well-known, well-researched story. But overall, yes, pharma will turn maybe 3 to 4 quarters from now. So it's a longer holding period. It's not like private sector banks you can buy. It's the Indian consumption story, or you buy some durables or two-wheelers or cement. That's a consumption which you can see happening in the next 2 quarters, and the story is coming. This story will take at least 4 to 8 quarters to unfold. So if you buy, you hold it for that. But valuation-wise, they are attractive. IT, I think, is still a no-go zone.
Okay.
IT will take time.
Okay. Ashish, Lupin, Sun Pharma, which of the two would you sort of recommend? What are the charts saying?
See, the overall tone for the pharma space has been negative. I agree to that. But at the same time, I think the valuations are extremely attractive in the large cap pharma space. At the same time, I think the defensive sectors, which has been a lackluster so far, should outperform. So both IT and pharma can probably be the reason why index can stay buoyant. And I would suggest that Sun Pharma looks very attractive at the current level. So the investment strategy should be in a staggered fashion. Do not go all in at the same level. Probably keep buying on the dips is the best strategy. Maybe 20% investment right now in Sun Pharma. And if it goes down further, keep increasing the investment. That will average out the position. And I think, yes, the entire pharma space has been correcting for more than 2 years now. And the cycle, if you look at the cycles, the entire sector goes for a 2 or 3 years kind of a correction, then reverses, and that sector then starts leading the index. So the pharma sector is probably going to bottom out soon and start leading the index.
All right. Ashish, thanks for that. Let's also take it across to Mr. Bhatt, who's of course been waiting by patiently. Mr. Bhatt, what's the best space according to you right now, where you think that earnings potential also looks pretty promising and valuations also haven't run up a lot?
Right. So I had mentioned last time, for example, two of the sectors which clearly are having comfort as far as valuations are concerned, which are currently clearly not the flavor of the market, so to say, which are IT and pharma. So we still continue to like these sectors from the valuation perspective, given that a lot of concerns seem to have been factored into the relative underperformance that we've seen in these two sectors. We also like sectors such as cement and consumer stocks, and even auto and auto ancillaries. We are of course we would be selective within all these sectors, but we see a good element of traction, not just in the current quarter, but over the next few quarters in these sectors.
Right. I'm afraid we've completely run out of time on this show. I want to thank all three of you for taking time out for us and, really helping us with our viewer queries as well. With that, we'll say goodbye on this edition of Smart Markets. Thanks so much for watching. Up next, of course, is India Tonight.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.